Hello, hello. This is Ginny Bowling with the Pivot to Prosperity podcast, brought to you by Pivotal Real Estate Investments, where we help our investors build wealth and income through commercial real estate that also improves communities. Today, we have Stewart Heath as a guest here. Thank you for coming, Stewart.
Thank you so much for having me.
Yes, yes. Well, you are a part of the mastermind group that I belong to, Raise Masters, and we both enjoy that tremendously, I know. And and you have been a CPA, 35 years of being a CPA. So you
Yeah.
have a whole different slant on things that I think that the audience will really enjoy. So if you would tell the audience about your journey into real estate.
Sure. Thank you again for having me. Yeah, I think CPAs probably have a different slant on most everything. Some of it's quite boring. I think the way I think about it, at least for me, simplifies it down because most of the time real estate's really about the numbers and very comfortable with numbers. And then there, of course, is the sort of the external factors which you have to develop a sense for when you're looking at a piece of real estate to acquire. But my story is simple. Grew up here in Middle Tennessee. My dad was a CPA, really had no idea what that meant. Go to college, major in accounting, become a CPA, went to work with one of the big international firms and just like, oh God, this is awful. And so naturally, after about 4 years, I start my own firm doing all of these awful firms, but at least I was doing it for myself. And what was really interesting, I got out of college in 1985. And so the very next year, Ronald Reagan had been reelected for his second term. I think that's right. Anyway, they passed the 1986 Tax Reform Act, which, if you're old enough to remember, devastated several sectors of commercial real estate. Multifamily apartments was one of them, because there was a whole industry called basically called the tax shelter industry, basically using a limited partnership form of taxation. And so the 86 Act had a retroactive impact. They didn't pass it till like October of 86, but it was retroactive back to the first of the year and eliminated a whole bunch of these deductions, 4-to-1 depreciation, and it was awful. And as a CPA, I was helping clients close down these things. A whole bunch of properties went on the market all at the same time. And I'm young and I don't know what's what. And so I sort of come into the business world with thinking real estate is bad. It's not a good place to go. And I remember bankers talking about, we don't lend on real estate anymore. And from this side of history, it's like, well, that's like the dumbest thing ever said. To me, real estate is it's called real for a reason because it's real. It's
Oh, I
physical.
love that.
You
Yes.
can touch it. It's not going anywhere. I mean, it's not to say that it's not riskless, but it doesn't have four wheels and can be in another state in a matter of hours. So so anyway, my journey to real estate really had some roadblocks to it. But frankly, after several years, I had built up a pretty good CPA practice of my own, and I'm making good money. And one night, it's the middle of tax season, and it's probably not night, it's probably about 2 a.m. And I'm sort of taking a break, from doing taxes. And I just this epiphany, this is, look, you're making great money, but you're not building anything. You know, Once you bill all these tax returns, what do you got? You don't even really have your customer list because they can go to H&R Block the next week. And so this guy came on the TV, and who you may remember, called Carlton Sheets. And I used to make fun of him. And he had this no money down, how to start buying real estate with no money down. And so, hey, it was $159 money back guarantee. So I bought it. And so after tax season, I start reading this thing, and it's not so bad. And so within a few months, I bought my first duplex. And within a few months after that, I bought 14 duplexes in one transaction. And so forth and so on. So, and I sort of fell in love with real estate and just I loved going and seeing the properties. I loved talking to my tenants, but I kept adding and adding and adding and doing what some people call the equity ladder. I would wait for this property to appraise, I'd refinance it, take that cash out, buy something else, and so by the middle of 2008, I had a personal net worth, according to appraisals and whatnot, of in excess of $15 million. The bankers were all happy; they all loved me, and until about 90 days later. If you remember 2008,
I was wondering where that.
yeah. At this point, so Bear Stearns had already collapsed and Lehman Brothers was gone. And so I remember this personal financial statement because I pulled it for a bank and I'm patting myself in the back, congratulating that there's not a number on here that's fudged in any way. All the big important numbers were based on appraisals, fairly recent appraisals. But the big problem with that, there wasn't a lot of cash on that financial statement. So 90 days later, we're in the middle of a presidential campaign. Countrywide Mortgage had announced on like July the 28th that they couldn't fund all their mortgages on the 31st. And it was like, oh gosh, something bad's about to happen. And so I figure about 90 days later, end of September, I was probably underwater $5 million because I had all this property, most of it in some stage of development, none of it stabilized. And you couldn't sell it. You couldn't borrow any money on it. It was just the world had stopped. I think Warren Buffett said, now we're going to see who's been swimming without their trunks on. And
Yes,
the tide went out and said, well, it was me. And anyway, so I spent the next year or so giving all of that stuff back to banks and went all the way under. But I never blamed real estate for that. I'm a CPA. I kind of built a pretty risky house of cards there, and I knew it. And I just needed to make it another 12 months, and I would have cashed out a few $1 million. That was the thinking. So anyway, went back and whole time I'm practicing as a CPA through all that. I ended up needing to get a job, and so I got a job. There was a lot of personal turmoil in that as well, as you might imagine, and took a couple of C-level jobs, and then in about 2017 started Harvard Grace as a fractional CFO firm, and all the while I'm just like, gee, I sure do love real estate. And so come along 2020, I formed the company Harvard Grace Capital to do syndicated real estate deals. And I was so excited I was getting started. And then this little thing, maybe you heard of it, called the pandemic came along. and it was like, the stock market crashed. Everybody thinks they're broke. And then in the second quarter, everybody had more money than they knew what to do with. Because of PPP loans and stuff like that. Anyway, we didn't do much in 2020. We did gin it up, and that's when I found Raise Masters, and we did gin it up and put a contract on an office building in Spring Hill, Tennessee, which actually belonged to one of my clients. And we finally closed our first deal in January of 22. And so now we have closed on 4 transactions. A couple of those are in, we have an expansion going on the storage facility. So they're getting bigger and better. And then we're doing a bit of a conversion on a medical office building. That's a fairly small deal. But anyway, it's still fun, and it's going to work out really well for everybody. So anyway, that's kind of my story, how I got here. Maybe more than you wanted to know.
No, I think that's terrific to hear, especially because so many people, especially that I know, are older. They are pretty much done with their career and they're looking around at what should they be doing. And we know the stock market crashed. We know that it always does have its ups and downs, but businesses can disappear completely.
Yes.
Real estate, going back to that, what I constantly am saying, we need it. We're standing on it. We are housed by it. We go to it for offices. I mean, we we know it's a durable asset and we know it's not going anywhere.
Yeah.
But so yeah, talk a little more about your investors are people that used to be clients, is that right?
Our first round, our first deal that we did were mainly people who had been my clients for 30 plus years. We've expanded that greatly since then, and typically through referrals. We do very active stuff. We do podcast appearances. We go to a lot of meetups, and so obviously the social posting and things like that to try to expand that investor base, and we have. We're always looking to meet new people, but for the most part, it is people that we have met personally and gotten to know who have invested the most with us. And as I mentioned to you, I think before the recording started, I'm coming down to Florida. I've got 3 trips planned in the next 4 weeks. Basically on a thank you tour, but just a talking tour. We don't have a deal that we're necessarily pushing right now, and so it's just a great time to go meet our investors and listen. And I always suggest that hey, bring anybody to dinner you think might also be interested. It's just a great time to go press the flesh.
Yeah,
and I think that's where most people get comfortable. We certainly have people that we've never met, which is amazing to me, but they do it on the recommendation of somebody else that knows us. And
right.
Yeah.
So you like to source deals and be the operator as well.
We do. Yeah.
And so who else does that with you?
I have a board, and one of the board members is essentially a part-time analyst with me, and he has a long history of sort of corporate, well, a long history in business, but spent some time in corporate real estate holdings. If you remember, Equity, great big company, Sam Zell's company, if you know that name. I mean, they were worldwide, and he used to do analysis for him. So sometimes it's a bit overkill for a $5 million deal, but I mean, he's always pushing me and asking the right questions. We have a full-time property manager. And so unlike some people who focus on a particular asset class, which I don't think is wrong, we focus on a geography. So it's sort of south of Nashville, Tennessee, down through northern Alabama. We call that the 840-565 corridor, which refers to 2 interstates that are sort of connectors. And it takes into account some small towns that are either feeding off of Nashville or feeding off of Huntsville. We love Huntsville. It reminds me of Nashville 30 years ago. And because I go to Nashville and it's like, well, I missed that opportunity and I missed that opportunity. I don't want to miss these again. And Huntsville is it's virgin territory to a large extent, and just is a exceptionally well balanced economy. But yes, we like to operate, and we originate the deals. I've had not great experiences with third-party property managers in smaller deals. I don't think that's their fault. I think sort of the business model is broken. When you do everything off a percentage, there needs to be a floor, generally, and to keep good people incentivized to work for you. So anyway, we do that ourselves. It's a bit of a loss leader, but as I'm also an investor with our investors, it's just something that we do, and we do charge whatever the market rate of property management is, but it probably covers 75% of our costs month in, month out. But it's the only way I know that I can deliver the business plan that I sold my investors on, is if we are driving that. So.
Yeah, no, perfectly understandable. And probably much depends on what the asset is too.
Yes.
Multifamily is a little more hands-on with dealing with a lot more people than an office. So talk a little more about the assets and maybe an experience of something that's occurred in one of the offices or rehabs.
Sure. Well, our 4 holdings right now is a suburban office. And as I said, that was our first deal. We bought it from a client of mine. So I had sort of been managing it for 4 years before we bought it. So there were no surprises with that deal.
Yeah.
It was a fairly tense situation just because I was in the middle and I didn't ever want to be perceived as trying to take advantage of my client. But they were very gracious about it. And, we got two appraisals and we blended them together, and that was the purchase price. Was great,
Yeah.
but since then we've been able to turn over tenants without vacancy and raise rents. And it's just, we've completed a lot of TI work this year. Been pretty frustrating. So anyway, that's an asset I call suburban office. Some people might call that retail. I said, well, not really. We're not talking about glass front doors or anything like that. So I got a dentist and an insurance agency and a mortgage company and a company of home health. I mean, they're offices, but they're not in a central business district. This is just a suburban area. Yeah, so it could be a medical office, but it's not. It's got all kinds of different tenants. Our
And
second deal, go ahead. Yeah.
TI is tenant improvements. Just
Tenant
for the
improvements.
listener.
Sorry.
Yeah. No worries.
Yeah.
Go ahead.
Our second deal was a fairly large storage facility, already operating in Huntsville. It was a niche play. They built it specifically for RVs and boats. So all of the units are really big. And I knew they were significantly under market with their rates. And so we went in there and, not very popular move, but we went in and we started raising rates, like from $375 a month to $500. We did it in cohorts just so that we didn't have any mass exodus at the same time. And now we've come full year and we're adding 5% increases to that now. And our street rate is still another 20% higher than what our existing tenants. So that's been a great one. Huge increase of gross income. And you talk about hands-on. Now, a storage facility is a bit of a retail business, and there is a lot of tenant interaction. There's a lot of tenant misbehavior, if you will. But like good managers, you get those people out and then you refill them. We're still full now, and it's really kind of my intent to sort of raise the rates until we've got about a 5% vacancy out of 125 units, because that's really should be optimal net operating income. I'm sorry, I'm geeking out now because that's the CPA and me coming out. Says, yeah, would you rather be full or would you rather have optimum net income? Well, I want the most net income. And there are actually problems when you're 100% full because you can't service everybody that comes along. So anyway, after that, we did a medical office building, also in Huntsville. And there was a space in it that had never been built out. The doctor that owned it used to work on his race cars in there. And so we went through the variance process, and we're actually putting storage in there that's going in later this month. It's kind of a niche play. It's just about 30 units, but we're right in the middle of sort of a medical core, and they have some pretty huge records storage requirements, medical people, 15 years after they're no longer your patient, they got to keep your records. And there's not another storage facility within 3 miles. So of all of these. So, so we think that that's going to do well. And then after that, we just closed our last deal in December, which is a retail center in Madison, Alabama, which is surrounded by Huntsville, but it's sort of the upper scale community of Huntsville. And it's we got some medical tenants in the retail and then some other, it's sort of a service retail. It's not it's not traditional retail. Anyway, so those are kind of things that we've been doing. Hadn't had any real hiccups yet, knock on wood. So,
and you're structuring those by syndications?
Yes.
Okay.
Every one of them is in its own legal entity.
All right. And so they're 506Bs?
Cs.
And so do you have a minimum investment amount?
Generally, it's $50,000 stated. Many times when we're starting a new relationship, somebody will say, well, can I do 25? And most of the time we say yes, especially if it's a friend of a friend, and you have a belief that there's going to be several follow-on investments, but those are one-off requests and one-off decisions. So,
Yeah, right. Are you taking any 1031 exchange
yeah,
situation?
we did that with our storage deal, and I would say if it's the right situation and the right people, and it's enough money, then it's a bit of a hassle, on our side to do that, but happy to accommodate with the right situation.
What would you say would typically be the minimum to make it worth all the extra legal work to make them a tenant in common, right?
Yeah.
Yeah.
Yeah, and there's the tenant in common agreement that gets recorded, which basically says, yeah, you're a tenant in common, your name's on the deed, but we're still in charge. That's what that tech
Yeah.
agreement would say. But I would say probably $500,000,
Yeah.
depending on the
That's
size.
pretty common. Right.
Yeah.
Right. Yeah.
It's just a lot of effort, and it's a lot of effort for them too.
So what do you see for 2024?
Interesting question. I have sort of been all over the board. If you look at some of my monthly newsletters over the last 6 months, I've been pontificating. We've been hearing since Q3 of 22 that the great debt wall is going to collapse, and it was supposed to start in Q2 of 23. I'm ready. I'm waiting. I'm looking for all these deals and foreclosures and bank workouts, and I hadn't seen any. I'm not saying that there aren't any, but even this morning on CNBC, I heard that most of the time banks are actually working things out with these borrowers, when it can be. Uh, so I'll break it down like this. In my market area, which is essentially the Tennessee Valley, and even a little bit beyond in the broader South, I don't think there's going to be a lot of disruption. There will be pockets of opportunities. Yeah, I've already heard from an attorney I know down in your area that he knows of one or two that are all going through workouts that he doesn't think will be successful. So yes, but there's always one or two of those things, no matter what the conditions are. So I think there's going to be massive disruptions in some of the bigger city centers, the same cities that happen to have populations migrating out to Texas and the South and stuff like that. So I think that's where you're going to see a lot of this problem. So once again, it comes back to rule number one: all real estate is local. And the problem is that the real estate financing is global. And so, why we can't have different rates in Huntsville, Alabama versus San Francisco, I don't know. But because the Fed, controls the banks and they loan to the banks all at the same rate. That just is what it is. We're never going to fix that. So I've sort of come to the point where I believe the Fed has actually engineered a soft landing. That does not mean that it's not going to be bumpy, but I don't think there's going to be a severe recession. I'm not even sure there'll be a recession at all. We're already slowing down. I don't know if you have been doing a capital raise lately, but the last one we completed was very different from the last one we did of 2022. People were far more cautious. We had to recover from 600,000 of commitments, real commitments that then backed out on us, and we recovered, but it was like, well, that was unnecessary. Yeah, I mean, people are they're being cautious with their funds, and I don't blame them. I think there's a lot of unknowns, but my guess is things tend to stay pretty stable during an election year, unless it's 2008.
Yes.
um, but I don't know. What do you think?
Well, I do think there will be some foreclosures and shakeouts because in Florida, the prices got too high, I felt.
Yeah.
I didn't win any contracts. I tried to get some properties, but I think that the prices that were paid were a little too high. And so the pendulum has to swing. There needs to
Yes.
be a correction because people that live here can't live here,
Yeah.
and the ones that could, some have gone back wherever, but it's not, yeah, our rental rates went up like 24% in 2020, 21. And so a lot of people were still projecting really high growth in rent even after that.
Yes.
And vacancy is low and all that when we know we've got tons of new units coming online. So I do expect there to be shakeout in different areas of Florida. But like you say, location, location, location.
Yeah.
And
Yeah.
I was an appraiser in the 1980s and appraised a lot of those properties that went belly up or, would have, in some cases, they were just starting construction, some they were finishing. And it depended on where the location was sometimes too, if someone would come in and take it over. We saw a lot of both situations. And so I think we're going to have a correction and it will
Yeah.
be probably, especially in those areas that have already been losing population and don't have the regulatory environment that attracts real estate people. If you can't attract real estate people, you can't expect real estate to get remedied very well.
Right.
So, but I do feel like it'll be a good year for investors that
Mhm.
are cautious and careful and ready to pull the cord. And so I'm hoping this will be, what we see in not just Florida, but I also like Atlanta, not all of Georgia, but certain areas of Atlanta and the
Right.
Carolinas, and haven't gone up into Tennessee Valley though, and I'll have
You
to
should
look
come and
again.
visit. It's
We used to
quite,
ride horses there way back when.
yeah. So did I.
Yeah,
Until
did
I
you?
got too
Okay.
big for the horses. Yeah, actually, the U.S. Census Bureau puts out a pretty good population migration map, and I put this in a newsletter not too long ago, and it's sort of down to the county level. And so, even in some of the southern cities, you see some migrations back out of the cities, which is a reversal from 10 years ago as people were flocking back to downtown Birmingham, downtown Nashville, downtown, and so yes, there's going to be some pain in places like Nashville. Oh no, Nashville's the greatest place on earth, right? Um, but their rents got too high. I remember looking at a deal in 2022 that, and this was after interest rates were already starting to inch up. But this deal called for 15% rate increases in rents for the next 3 years. And I would have been embarrassed to even put that on paper. And then it didn't cash flow until year three.
Ooh,
And it was because they were buying it at a three cap. I'm like,
yeah,
I
don't
just,
buy that.
no, I just, guess what? I know somebody who got in that deal. They just had a capital call and not a small one. And so, I think, I think where abuses have been done in the past, there's going to be corrections. And so, but we're cash flow investors. So, we kiss a lot of frogs, but not very many of them turn into princes. So
Yeah, it takes a lot of deals to find that one for
yeah.
sure. Well, and so do you still do some fractional CEO work
I do CFO work.
or
Yeah.
CFO?
I have whittled down the practice and not replaced clients when I've graduated them onto their full-time CFOs. But I have one or two, and I do enjoy that work. And I'm not saying I won't do more of it, but it's a little bit like a marriage. When you sort of go on the inside of an organization, and so, but always open to have the conversation.
Yeah, I would think that there might be a lot of people in the masterminds even that might be interested in having a
I've
fractional
had a lot of
CFO.
those conversations and tried it one or two times. They don't like the rate. And I know it's like, I know it's ridiculous, but I mean,
You can
yeah,
take some of it in equity, probably, right?
yeah, I used to do that years ago. Never ended up collecting on those. So,
Oh no. Well, you got to
but
change that.
I'm always open. Yeah,
Right.
if it's the right operator, then yeah, we can talk some equity. So,
So say again what asset types you're looking for, and then oh, I forgot to give you a little warning. I'm going to ask you for a pivotal person or event that made a difference in your life. But
yeah,
to warm you up, you can go ahead and say again what is, explain a little more what the assets are that you
yeah.
would prefer.
So our assets, again, are anything commercial. We're always open, and we analyze a lot of multifamily properties, but we always find that they're typically a little too rich for our blood. We are not necessarily looking at the value adds, the fix and flip type things. We're trying to stay out of development. Our favorite thing is a property that's been mismanaged for several years, and so that over the course of 2 to 3 years, we can fix leases, we can fix landscaping, we can do other stuff like that, and do our own brand of value add that way. You make a lot of money with that too. But anything that's commercial, and so that includes multifamily, office, especially medical office, if it's the right retail in the right location, and storage, we're aggressively going after storage.
Right.
But so is everybody else. So,
All right. Okay. And so pivotal person or event for you?
well, my pivotal event would definitely be my 2008 2009 experience, where I basically formulated the investment philosophy that we pursue today, which is the need for reserves, the need for recurring cash flow, and the need for having a backup plan when your main plan, who couldn't ever possibly go wrong, but when that plan does go wrong, it's just preparedness. You
Okay.
know, I'm an Eagle Scout. Be prepared. I completely forgot that. Back in the early 2000s. So that would be my pivotal event. I failed to mention that. After all of that turmoil, and I mentioned that I didn't have a lot of cash, didn't have any reserves. Had I had reserves there as little of $300,000 to carry some of the properties, I might still have some of those assets today. I mean, but I didn't have, I had no
Gosh.
backup. So yeah, so it's not like it's a lot of money, but just like if you don't have a plan uh, for what you don't know, then you're just gambling. There's a big difference between investing and gambling. So,
There is. Absolutely. One other thing we talked before we started recording, your epiphany.
yeah,
You one day
yeah,
realized
yeah. I
what
was the epiphany was when I was watching that late night TV and watching Carlton Sheets, and so it was the epiphany because I had to overcome all of this negative information about real estate that I had collected earlier in my career, and that the epiphany is this sort of this is the original asset class. This is the original investment, and it's leverageable. You don't have to have all the money to buy the asset. It's real. It generates income. Whether or not you show up for work or not, or have a billable hour, so to speak. So the epiphany is that real estate is, it's also the original subscription business. For the last 10 years, the tech world acts like they invented the subscription business. And of course, we all buy our software usually on a subscription basis now. You and I probably remember when you would go to the Office store and buy your latest version of Windows or Word or Excel in a box, and no, now we pay a subscription for it, and that's what real estate is. It's the original subscription business, sometimes it's not going to make you all the money in the world. You're not going to. It's likely not going to be a home run unless you've just done a really successful development, but you're likely not going to lose everything either. So
Right. So it's a subscription in maybe two ways. I think you're saying it in the way that it's durable and it has regular returns.
recurring
It's a
income, yes.
little volatile, but it's also a subscription from way back when, because the first transactions were usually on a land contract. So that
Yes.
was like a subscription too. But yeah, no, good points. And I love it. Well, so tell people how they can reach you.
You can reach me a couple of ways. My name's down here at the bottom of the screen. So you can go to stewartheath.com, which will take you to the Harvard Grace website. There you can find all my contact info, a Calendly link. I invite anybody and everybody who wants some time, use that, reach out, get a phone call. You can find links to some of our resources that are free. We will hit you up for your email address. But some of them are good. You know, what you should be asking your passive
They're all
investment
good. Don't say
sponsor.
some of them are good.
Right. They are all good. Yeah, questions you should ask your investment sponsor. Yeah, you know, to help you due diligence to sponsor if you're thinking about that. I have a new series that just came out about why entrepreneurs should be investing passively in real estate. You know, entrepreneurs are great people. Usually, they're great business people, and they've got anything and everything invested into that venture that they're working on. A lot of times, they're making a lot of good cash flow, but you need to start to diversify. And real estate's a great place to diversify, and should be a relatively stress-free way to diversify. So that's how you contact me. And again, anybody who wants to chat with me, I'm open.
Very good. Well, thank you very much, Stuart. Appreciate it.
Thank you so much for having me.
We'll be in touch soon.
Okay.